Hello friends, every banker must have certain key principles that they use while they undertake and monitor the credit risk. We'll look at 10 such key principles of how the credit risk should be monitored. The bank should follow the know your customer axiom to the entire extent. The RBI and other regulators have specified that KYC is mandatory. However, the bank should not look at it merely as a compliance matter, because knowing your customer thoroughly well, understanding the customer situation from time to time, going beyond the documentation is extremely important for the bank to appraise the risk while undertaking the decision to lend, as well as in subsequently monitoring the risk. The bank should develop a very good understanding of the mission and goals of the borrower. What are the borrower's goals and how it is tied to its mission? For example, if the borrower wants to establish itself as number one in a certain industry or field, obviously it will come with lot of responsibilities such as managing the scale, getting the right kind of people, making sure that you are in line with the regulatory changes. So bank has to be aligning itself to the customer's mission and goals to understand those very well and understand its impact on the risk that the bank is undertaking. Understanding the customer's financial profile is extremely important for a bank. The customer's financial profile is very well reviewed when the bank undertakes the decision to lend or to sanction any kind of a credit product. However, subsequently the financial status of the customer keeps changing. They might borrow more, they might make more profit, or their profitability may be under stress, or the cash flows may get impacted. Therefore, getting the timely financial information such as, for example, the stock statement, the review of the status of the assets, the quarterly results, the 6-monthly results, as well as the annual report of the customer is extremely important, and the bank has to review this from time to time in order to reassess the credit risk involved in the exposure to a particular customer. The bank should understand that the history often repeats itself. We have had a lot of credit crisis and economic crisis in the past. For example, the learnings from global financial crisis of 2008 and the learnings from the bank NPA crisis in India in the last 1 decade should not be wasted away. The bank should carefully monitor the performance of every asset and of the portfolio to make sure that they are basically following the prudent practices in line with the lessons that they have learnt in the recent past. The bank should carefully monitor the customer's account as well as the entire portfolio to look at whether there are any early warning signs of the credit deterioration. For example, at the portfolio level, let's say a home loan portfolio, if the CIBIL score of a particular class of customers is dropping, that is a potential indicator of a risk in that particular class of customers. If in a particular region, the LTV ratio, the loan to value ratio is coming down because the property prices are going down, that indicates increased risk for bank in that particular region. Likewise, the bank has to monitor at the portfolio level as well as at the individual level to assess the changes in the risk in the particular borrower or the portfolio. The customers might be undertaking different initiatives. They might be diversifying, they may be adding capacity to expand. So all these growth initiatives should be carefully monitored by the bank. Most banks put a NOC clause when they sanction the loans. For example, there no objection certificate is required for the customers to undertake expansion or acquire or divest assets beyond a particular specified amount. In that case, the bank has to be informed by the customer about their expansion activities, and those growth plans should be very carefully assessed by the bank before they allow the customer to undertake those growth plans, even if they are not borrowing from the same bank, but they are resorting to borrowing from some other bank. When a bank is dealing with a wealthy family, they should be more careful in terms of assessing the actual wealth of the wealthy family. They should, without hesitation, get all the proof of the wealth of the family. For example, the wealth could be mainly coming from holding of equity shares in listed companies or maybe unlisted companies. The valuation of shares of unlisted companies is very challenging task. So banks should be very careful in assessing that valuation. Likewise, even if the investment of the family is in real estate or any other assets, the bank should clearly obtain evidence and also see whether those assets have been mortgaged to someone else. In case of listed company stocks which have created huge wealth for many rich families, not just in India but across the world, in that case the risk should be taken into account by way of changes in the market prices of those listed companies. While sanctioning the credit, as well as subsequently, the bank should carefully monitor the impact of certain factors on the profitability and cash flow situation of the borrowers. This is called sensitivity analysis. There are certain factors to which the customer's business is sensitive. For example, the price rises, the changes in the interest rate, the changes in the foreign currency, the relations of the country with certain other countries. For example, lot of IT services companies are dependent on business with US and Europe. So any kind of barriers that these countries might put will severely impact these companies. So these kind of factors have to be analyzed by the bank to understand the potential impact on the profitability and cash flows of the customer. The bank should carefully analyze the liquidity position of the customer. The liquidity position of the customer is traditionally analyzed by looking at ratios such as the current assets ratio, the quick ratio, and the cash ratio. Likewise, any kind of liquid assets that the customer holds should be appraised by the bank to understand whether the liquidity is really good. There are certain factors that will determine the liquidity. For example, how fast you can convert that asset into cash. Second, how much is the transaction cost involved? What is the price impact? And then are there any government duties and taxes upon liquidation? So the bank should understand the liquidity of the customer. There are industry specific liquidity factors that the bank should look into, and also they should look at the long-term liquidity, or what is called the long-term debt to equity ratio or debt to assets ratios, to monitor the liquidity of the customer. While appraising the customer initially and also subsequently during the tenure of the loan, the bank should keep in touch with the other lenders and understand the situation of the customer with the other lenders. The other lenders might have useful information that will help the bank in terms of assessing the current credit risk in the borrower. Therefore, keeping good relationship with other bankers who are actually bank's competitors is very important for a bank, especially when it comes to large borrower accounts. The bank that follows these principles of monitoring credit risk very well is likely to have a good asset portfolio over a period of time, and therefore will succeed to grow their business as well as manage it profitably. I hope you understood these 10 broad principles of monitoring credit risk very well. If you did like this video, please do share with your friends, subscribe to my channel, as well as comment on the video telling me what kind of more videos I should be producing in this domain. Thank you very much and cheers.